Hi everyone, I'm Jo from the marketing team at Netwealth. Thanks for joining us today for our Netwealth Portfolio Construction webinar. This is our series designed to help you discover new investment opportunities and see wealth differently. We're delighted to have Gary Lawrence join us today, and he's going to share how Perpetual invests in a low interest rate climate. Before I hand over to Gary, I'll just run through some quick housekeeping. Financial advisors who've joined us will receive 1 CPD point. To receive this point, you'll need to be online for at least 30 minutes. You'll then receive your CPD details within the week. This webinar is also being recorded, so everyone will receive a copy of the session and slides via the email within the week. You can also submit questions via the question tab in the toolbar to the right of your screen. And please be aware that the information shared today is general advice only and is not intended to be professional financial advice. For those of you who don't know Netwealth, we're an ASX-listed company nearing our 20th year, and our purpose is to help Australians see wealth differently and discover a brighter future. We provide investors with a range of investment and super solutions via our platform. Investors can manage their super and investments using our portfolio tools, access a range of reports and online charts to analyse their portfolio, and stay up to date with changes in the Australian stock market by accessing live prices and charts on individual stocks. Our platform also supports financial advisors with a wide range of financial products and services to help manage their clients' investments and super. I now have the pleasure of introducing Gary Lawrence from Perpetual Investments. Gary joined Perpetual as an analyst in 2008 and is now the Global Equities Portfolio Manager for the Global Share Fund. Gary has a Bachelor of Commerce and a Bachelor of Law from the University of New South Wales. Over to you, Gary.
Great, thanks, Jo. So today I'll talk a bit about investing in global equities and how we position the portfolio for the current environment. So maybe just starting on slide 8, you can see that there's been a lot of volatility in global equities markets over the past 6 months. As you all know, there was a big sell-off in the December quarter as the market worried about the trade wars with China and the US, as well as interest rates rising in the US, and that created quite a bit of fear about what the implications were for the global economy, and you saw equity markets selling off quite considerably. Since then, in the March quarter, we've seen a big rebound. So the MSCI World Index fell by about 11% in the December quarter, but then it's recouped all of that in the March quarter as the markets realized, firstly, that the global economy, while it's slowing in terms of its growth rates, it's still growing at a steady pace. We're also seeing that interest rates aren't going to be as big as a headwind as the market thought. So the Federal Reserve in the US has come out saying that interest rate rises are on hold for the rest of the year. And you've seen a flattening of the yield curve. So a lot of those fears have been dissipating. We've also seen more negotiations between President Trump and President Xi, and there's more confidence coming back into markets. What I will say about the global economy is that I think that there has been a bit of a slowdown caused by weakening business confidence because of these concerns. So we have seen weakening PMIs, especially out of Europe and Asia, but also the US. In the past month, we've seen a bit of a rebound in the Chinese PMIs. We've seen more lending growth going into the system, and the Chinese government using both monetary policy as well as fiscal to stimulate a pickup in demand there. And then just globally, we've also seen pretty consistently healthy consumer demand and consumer spend, and consumption is quite a big driver of GDP growth around the world. With most developed markets, you see consumption representing about 65% of GDP. So we're watching the global economy closely, but we still think that conditions are, still quite healthy, and we're finding a lot of good stock opportunities. This slide here just shows you the disparity in terms of valuations in different styles. So because you've seen a flattening of the yield curve and low interest rates for such a long period of time, what's happened is you've seen the growth stocks outperforming, and actually you've seen an increase in multiples and what people will pay for growing stocks. So it's been quite a tough period for value investing, and a lot of value stocks have actually derated and their multiples have declined, while these growth stocks multiples have increased. And we've got some slides on following slides showing that. On this slide here, you can see how the US market has actually quite considerably outperformed the MSCI World Index, and part of the reason behind that is that the US market does have a larger share of technology companies and a larger share of high growing companies which have seen that re-rate. Part of it is that there's been a bit of a flight to safety, and people are more comfortable owning US dollars when there are concerns. But what we're finding is that when we're looking for high quality businesses that are growing at attractive valuations, we're finding more of them outside of the US today. So this slide sort of shows you how different markets around the world have been valued, and P multiples around the world, and also some of those different styles. And so you can see the S&P is trading slightly above average, slightly above the 10-year average. In terms of different styles within the S&P and within the US, you can see that when you look at the Russell Value Index, the stocks are actually trading at 10-year averages, but then you look at the Russell Growth, and the multiples for those growth stocks are trading well above their 10-year average. You look across and MSCI World is actually trading around its 10-year average PE. You can see that emerging markets are actually trading slightly below their averages. So we look at companies like, say the banks in Korea, and they're trading at all-time multiple lows of about five or six time PEs. And similarly in Europe, the market, we're finding plenty of opportunities, and the multiples there are in line with long-term trends. So you can see the breakdown of our fund, and that represents those opportunities that we're seeing, where because of the fears around Brexit and Europe, valuations are very attractive. So we've gone overweight Europe because of what's happened in the US and its outperformance. It is getting harder to find these discounted stocks. So we're underweight North America, and we've consistently been overweight Asia ex Japan, because we like the services sector, we like the consumer, healthcare, technology sectors in Asia, where you tend to see much stronger growth rates in these types of sectors in emerging markets. And we're close to the region, and we've been investing in the region for a very long period of time. So that sort of highlights some of our geographical weights. In terms of sectors, we've got a few themes running through the portfolio. So as I mentioned, we think that the consumer sector is still quite healthy. So we found some really discounted and high quality stocks in the sector. So companies like Disney, Whirlpool, I'll talk a bit about Whirlpool later on. We've always liked investing in structural growers. So online advertising and transactional businesses have been businesses that we've owned since inception of the fund in 2011. So we bought into Alphabet in 2011, leading search engine globally. We've also currently own eBay and Alibaba, and those businesses we've owned for quite a number of years. Again, they're leaders in e-commerce. So Alibaba is effectively the Amazon equivalent in China, but trades at a significant discount to Amazon in the US, and Alibaba is growing at a very healthy clip, and has probably about over 50% market share of e-commerce in China. In terms of other sectors, we've been increasing our weight to some defensive sectors, as we do feel that the business cycle is sort of getting closer to the end, and so we've just been increasing the defensiveness of the portfolio. We've got some big positions in Nomad Foods, which owns the Bird's Eye brand in the UK, as well as Mondelez, which owns a number of brands that you'd all know, like Toblerone, for instance, quite a number of snack food brands. And then in terms of other sectors, we like software businesses, so we own companies like Oracle and Synopsys, companies that have very strong balance sheets, have sticky customer bases, recurring earnings in terms of subscription fees, and when you buy into leaders in those sorts of sectors, they do tend to grow quite nicely over a long period of time. Other themes that we've got in the portfolio, we like the industrial automation theme, and Siemens is one of the leaders there globally in terms of their automation products. And we've always been supporters of stock exchanges and the quality of those businesses, and NASDAQ's been probably one of our first investments in 2011. Again, a very high quality company, generates a lot of free cash flow, huge barriers to entry as stock exchanges are generally oligopolies or monopolies. So maybe just to talk through some of the positions that we have and some of the stocks and how we come about picking those businesses. So maybe just to start with the consumer sector, you can see on this slide that we highlight a number of stocks and how they're valued. So Coca-Cola is a brand that everyone knows. Coca-Cola in the US, the earnings aren't really growing that much, but it trades on a PE multiple of 21 times. Then you go to the next stock, Pinnacle Foods, and Pinnacle Foods is actually a very similar stock to Nomad Foods in that Pinnacle Foods has been consolidating the frozen foods industry in the US for a number of years now, and they own the Bird's Eye brand in the US, while Nomad Foods owns the Bird's Eye brand in the UK and Ireland. And you can see Pinnacle Foods trades on a P of 23 times. So we were alerted to Nomad Foods through running through some screens, and we noticed that it was trading on a P of 12 times earnings. So one of the cheapest consumer staple stocks out there. And when we did more research on the stock, we saw that it's actually a really high quality business, but trading at a significant discount to the market. So you can see our entry price here. So we started buying in 2016 at about $12 US, and we continued to buy over the past few years. So we bought when it dipped to around $10. And we had the view that it's a high quality business. It's misunderstood by the market. And the reason why it was misunderstood is that it was basically being, it saw a change in management. So the chairman owned about 10% of the company, and they basically came in and they started to consolidate the frozen foods industry in Europe by buying the Findus and Igloo brands in Central Europe and Scandinavia. So frozen peas, frozen veggies, and also frozen fish and frozen chicken like Bird's Eye. And the market didn't really realize, the businesses that they had aggregated and the potential for those businesses. And with the change in management, with the change in the chairman, they also had a new CEO come in, and he's ex-Anheuser-Busch, has been in the food and beverage industry for over 20 years. So was a CFO of Ahold Delhaize, which is a leading retailer in Europe. So he had a tremendous amount of experience in the space, and he came on board a few years ago and put in about $50 million of his own money, and helped the chairman and the management team to really refocus the business, reduce the number of SKUs that the Bird's Eye brand had, and improve the marketing. And over the past few years, we've seen a real pickup in the organic growth of the business, where when they first came on board, the business wasn't really growing very quickly, and now it's growing mid-single digits organically. But what we find unique about the business is that it's not one of those slow-growing, mature businesses like you'd see with Coca-Cola. It's actually run private equity style. They're very acquisitive. So over the past year, they've bought into brands like Goodfellas Pizza, which is a leading frozen pizza business in the UK. They also bought the leading Yorkshire pudding frozen foods business in the UK called Aunt Bessie's. And they've really consolidated the UK market so that they actually have 16% market share of the UK frozen food market, and they're clear number one, more than 2 times market share of the number 2 player. So we see a lot of opportunity for them to continue to consolidate the European frozen foods market. They extract synergies, cost synergies from merging businesses together, so that drives your earnings growth. And we think that the business can grow at sort of high single digits for quite a number of years to come as they continue to make acquisitions. The stock's only $4 billion market cap today, and this is how these big consumer brands are built over decades, where you have a good management team that continue to focus on their core knitting and what they do, and make acquisitions to grow the business. So we think this business can double, triple over the next decade. Now, just turning to another company that, again, one of our largest positions, Whirlpool, and most of you will have heard of the Whirlpool brand. So they're a leader in white goods, so washing machines, fridges, but also kitchen appliances. And what really intrigued us about Whirlpool is you can see that we've been in and out of the stock over the past 5-6 years, and we tend to buy around $130. We bought at that price in 2014, then we sold at about 180, and then recently in the sell-off last year, we bought back in, started buying at about 130 and kept buying in the low 100s. And we were intrigued that the stock got down to those levels where it was trading on a P of 7-8 times earnings. It currently trades at 9 times, but it has really high quality brands and market shares. So it's got over 30% market share in the US of white goods. It also owns quite a number of different brands like KitchenAid, which is a leader in small appliances. What's quite interesting to us is that Perpetual has been a large shareholder in Breville in the past, and I remember covering Breville for Perpetual through the GFC, and Breville got down to a P of 3 times. Breville's executed very well, and Perpetual's no longer a shareholder as the stock trades at 35 times earnings. Whereas now you look at Whirlpool, which has a whole host of high quality brands, and it's only trading on a P of 9 times earnings. And we think that what Whirlpool needs to do for the market to realize the value of the business is to spin out some of the businesses that they own. So the KitchenAid brand is very high quality, very similar to, say, the Breville brand. We think they could spin that business out. We also think that they have a number of assets around the world which the market's not valuing. So if you look at Whirlpool, they're the leaders in India as well as Brazil, and the Indian business is actually listed on the Indian Stock Exchange, and that business trades on a P of about 40 times earnings. We've spoken to quite a number of different analysts in the US and shareholders of Whirlpool as well, and they actually don't realize that the Indian business is listed with such a high multiple. So we think that there's a huge opportunity for the company to maybe spin out the Indian asset, or alternatively spin out their international assets into a different vehicle so that the market realizes the true value of the business. Telepizza is another example where in the Whirlpool case, we've actually been quite active in encouraging management to look at these ways of allocating capital to realize value. So we wrote a letter to the chairman and CEO and handed that to him. We've spoken to shareholders to support this level of activism. And then Telepizza is another example of where we've actually been quite active in the stock. And this is a different scenario in that in the December quarter sell-off, you can see that we bought our position, really attractive price. We think it's a high quality business, and the interesting thing about Telepizza is that it's effectively like the Domino's Pizza of Spain, Iberia, including Portugal, and also Latin America. And over the past 6 months, Telepizza's announced that they're merging with Pizza Hut in Latin America, and that's going to create tremendous synergies for them. Telepizza generates about 70 million euro EBITDA today, and they expect it to get to 100 million EBITDA over the next 3 years. So significant uplift in their earnings, and a lot of growth. And so it's not surprising that KKR actually, saw the opportunity with the stock price fall and bid for the company. And you can see on the chart there that at the same time that we bought in, very, very soon after, at the end of December, KKR bid for the company at a €6 share price. Now that €6 is only the same price that it was at in the beginning of 2018, and really doesn't reflect the true value of the business. So we aggregated a bunch of shareholders together, and we're looking at basically rejecting the bid, as we think that the stock's worth closer to €10. It's probably worth maybe €7 today, but if you hold on to the stock over the next 2 or 3 years and you wait for those earnings to get to 100 million EBITDA, we can see the stock being worth 10 to 12 euros. So we own about 3% of the company, and we're looking to reject the bid. We've been very vocal, writing a letter again to management, and the stock's actually trading above the bid price today. It's trading at €620. So that reflects that the market doesn't think that the bid should really go through. And there's been a lot of other European activists that have come on board behind us with the same view. If we turn to another sector, technology, and technology is all the hype today. Everybody wants to buy a technology business, and you can see companies in Australia. Australians don't really have a very big technology sector, so the companies that we do have are bid up to extreme levels, I would say, in terms of valuations. Whenever I talk to someone in their 20s, that they're all invested in Afterpay or Zip, and then you ask them, well, how much money do they actually generate in terms of profits, and nobody really knows. And you ask them, well, what's the market cap, and they have no idea that it's $6 billion. But you look around the world, and there are some really high quality businesses around the world that actually still trade at really attractive valuations. We've tended to find them. We're finding that the valuations in Asia are actually even more attractive than the US, even though you can still find good value in the US in companies like eBay, as I mentioned. So at the moment, we're invested in eBay in the US, and also Alphabet. We still think that there is a good sum of the parts story there. But we've recently invested in Alibaba and Baidu in the sell-off in the December quarter, as those businesses, Alibaba got down to about 20 times PE, but it has a lot of businesses that aren't being valued today, like AliCloud, where they've got over 50% market share, is not profitable today, but will generate significant profits for the company going forward. Another business that we've invested in Asia is Nintendo. Nintendo is listed in Japan, and it's a stock that our analyst Thomas Rice, brought to the fund, and really loves and sees a big opportunity. And what we see in Nintendo is that they're actually transforming and shifting to being more of a software company and more of a platform business than just hardware. So the market has been worrying about the level of the sales of their Switch console, and we're actually not as worried as the market. They're still on track to sell over 17 million units this year, and what we see in the value of Nintendo is actually the IP and the content and the software that they have. So everyone knows Super Mario Brothers, and and those brands have been going for decades. And I was in New York about a month ago and walked through quite a number of different stores. I spent a day just looking at different stores of retailers, and I was intrigued that the Nintendo store was actually the busiest store that I walked into on a Saturday, and that's because everyone actually loves these brands. They remember them playing them as a kid, but then their kids are going into the store and enjoying the products. And so Thomas has a Switch for his children. I bought one for my kids, partially to do some on-the-ground market research. But it actually is quite a unique product in that you can play their games on your television, but you can also then move the console and use it like a Game Boy. So we think they've got a unique product. They are also got a really strong pipeline of games coming out, and they're also opening up the platform for third-party games, which they haven't really done in the past. So we see a really good trajectory for growth for this business, and we think that in the recent sell-off that the valuation has become very attractive. Synopsys is another stock that we've owned over the past year in the technology sector. We like to say it's like the picks and shovels for the digital world, and it also reflects the software businesses that we like to invest in, that sort of sticky recurring revenue base that they generate, and the strong free cash flow and strong balance sheets that these businesses have. So if you look at Synopsys, they're a leading provider of design software and IP to the semiconductor industry. There's only really two players. It's Synopsys and Cadence, and Synopsys is a global leader with 30% market share. All the companies that are generating new chips, whether it be companies like TSMC, which is a leading chip manufacturer, or it might even be some of the in-house chip manufacturers like Google, for instance. They all need software to design chips, and as you're seeing, growth in the number of chips being produced, also the technicality and different usage of chips in the Internet of Things, it's really increasing the demand for Synopsys's products. So we see, a good growth profile for this business. Again, you can see on the chart that we like to buy these businesses when there's fear or there's a dip in the stock price. We got a really good entry in the middle of last year. Euronet Worldwide's another business that we bought into over the past year, and again, a really high quality technology company that was being mispriced by the market. So we bought into Euronet when it was trading on a P of 14 times. We like these fintech companies. So as I mentioned, NASDAQ, NASDAQ's a stock exchange. Euronet is a more of a payments platform, and they do a number of things in the payment space. So they own a whole host of ATMs, mainly in emerging markets, in Eastern Europe, for instance. And most people think that, well, no one's going to be using cash anymore. But if you go to Greece on holidays and you go to a Greek island, you'd be worried not to have cash in your pocket, because a lot of people only take cash. And so there's actually quite a bit of growth in the amount of cash around the world for different uses. And so Euronet's actually doing quite well in that ATM business, and they're consolidating the market in Europe, but they're also doing quite a number of innovative things in other spaces. So they're one of the leaders in money transfer. So there's a number of big players globally, and Euronet's taking market share. So often when migrants go and work overseas, they want to send money back to their families, and you need a company to help transfer that money. So Euronet is a leader in that space. And then finally, they are an online payments processor. So if you think about your Opal cards in Australia, the company that actually manages those Opal cars is Euronet. They are also helping Alibaba bring Alipay into Australia. So they've actually been working with Alipay and big retailers like Louis Vuitton, who are now accepting Alipay in Australia. So Euronet's been investing quite a bit in this payment technology, and even though people don't think about Euronet the same way they think about PayPal, it actually is a really high quality growing financial services technology company. And you can see that as the market's been slowly understanding what the business is, the stock's actually re-rated significantly over the past year. It's gone from 14 times to 20 times, but the business is growing its earnings at double digits. We think the management's really high quality and will continue to grow double digits. And Euronet's still a very cheap company when you compare it to, say, PayPal, which trades at 30 to 40 times, or some of these fintechs in Australia, which don't even have PEs. So you can see here on this slide, some of those businesses that I mentioned, and their market leadership in those sectors. And that's pretty much the end of my formal presentation. So I might just look to open it up to the floor for any questions. Please just shoot away with anything that you've got.
Thanks, Gary. We've got one question here. It's just on the source for the Whirlpool slide. It says it's back in 2017. And is it still current and accurate today?
Sure. So I'll just go back to that slide. So you're probably talking about this slide here. That's probably the last time that the company reported their market shares. So we do think that it is a good reflection of their dominance in those markets. You can't really see the exact market share in each of those markets. We think that in the US, they've probably got about a 35% market share. So I think that slide is still accurate to show you the market positioning of the company. Maybe the market shares have moved 1 or 2% up or down in each region, but it is fairly reflective of their position.
Sorry, Gary, I'll jump in and ask you a question. You mentioned that you look heavily in Asia as an area of interest to you. Is there any countries outside of Japan that really take your fancy?
Yeah, so in Asia, we have actually predominantly invested in Chinese exposed companies, not necessarily listed in China, but all their earnings being derived out of China. So as I mentioned, we've owned a number of technology companies in China, like Alibaba, Baidu. We've also owned a number of consumer companies in China, but listed in Hong Kong. So we own WH Group, which is a pork producer, leading pork producer in China. So packaged foods. They also own a number of packaged meat companies in the US. And we just think that the Asian region and specifically China are seeing this shift towards increased consumption, and consumption as a percent of GDP is still quite low in China at only around 40% versus the US closer to 70%. So the government has had over the past decade or two this focus on increasing wages in China, and the flow and effect of that is increased consumption. And so we think that if you own high quality brands, those brands will grow in terms of increased volumes into the population, but also increased pricing power and higher margins. So we like the services sector because the government does have a focus on shifting the economy from manufacturing and exports to more services and consumer related. So we've owned healthcare businesses in the past, and we just think there's a lot of growth when you look at the amount of spend per capita in a lot of different consumer and sectors and healthcare and different services sectors. It's still very low in China, as well as other emerging markets in Asia, than it is compared to developed markets. we look around the region, so we do invest in other markets in Asia, like Korea, for instance. We have found that Southeast Asia has been a bit more expensive. Valuations started to come back a bit, so we're doing more work on some companies in Indonesia, for instance. But our biggest weight has always tended to be Chinese companies, not necessarily listed in China, but listed in the US and Hong Kong, which are exposed to the services sector.
Thanks, Gary.
Thanks, Gary. We've got one more question here. What is your understanding or underlying reason for companies spinning off, and how does it make companies more investment attractive?
Sure. So I guess the underlying reason is that in investment markets and listed markets, the market tends to price pure plays at a higher multiple to conglomerates. And so we find that when you spin off businesses within the conglomerate, you tend to get an increased multiple and a re-rate for those businesses. So we were invested in eBay in 2011, and that was before PayPal was actually spun off. And you can see that once PayPal was spun off, the stock's probably tripled since they listed it. We also owned Expedia before Expedia spun off TripAdvisor. Again, though, by spinning off TripAdvisor, they saw a massive increase in the value of the businesses, and the shareholders of the conglomerate end up owning the piece of paper that's spun out. So you actually get a lot more value. And so with a view on, say, Whirlpool, if they were to spin out KitchenAid or spin out some of their international assets which aren't being fairly valued in the US market, then the current shareholders will actually see a real increase in the value of what they hold today.
Awesome. Thanks, Gary. Questions are coming in quick now. Here's another one from Renato. You mentioned it was likely we are in the final stages of the current business cycle. In an extreme low, in an extreme low interest rate climate, what could be the catalyst for major disruption to the current business cycle?
Sure. I think the biggest risk is business confidence and confidence in markets, and that can be created by governments and regulations. So we saw that the big sell-off in the December quarter was driven basically by people's views on the politics in the US. So you had Trump going after different countries on trade wars, and then you had a Federal Reserve and what they were going to do with interest rates and their policy. So it was more about government steps which caused fear in businesses and led to a big sell-off in equity markets. So I think some of the risks that we have today is that we do have this uncertainty around Brexit. We do have different elections coming up in Europe. And so the political environment isn't as stable as you'd like. So that affects business confidence. And if businesses aren't confident, then they stop spending in CapEx, they stop investing, and that leads to decreasing demand and global GDP. Australia is another example where we don't really know which whether the Liberals or Labor will be elected, but you can see that there are very different policies coming out of each party, and some of those policies aren't actually very good for stimulating economic growth. So governments can really have an impact on economies, and it's not just by using monetary policy, it's also the fiscal side and what they do with taxes, as well as how much they spend into the economy.
Great, we've got another one here. Do you think the surge in ETFs and other passive strategies have fueled the huge share prices increases in growth stocks? What do you think it's going to take before we see a value-based approach have its day?
Yeah, I do think that a lot of this growth and increase in valuations in the growth sector has been fueled by ETFs. So ETFs, people throw around numbers, but some people say it's 20–25% of volumes being traded in the US are effectively ETFs. And so obviously, if more money goes into a tech ETF, then the biggest tech stocks just go up in value with the ETF buying those stocks. So I think there are quite a lot of distortions being created in stocks. And interestingly, if you look at Whirlpool and who the two biggest shareholders are, they're actually passive investors like Vanguard, which are effectively just being driven by the ETFs that they've set up. And so, it can happen where the stock goes up because of an ETF, people buying into it, say, technology, but also if they're selling out of, say, housing or, other sectors to fund that investment, they actually can drive down stocks and stock valuations. I think part of the mispricing in Whirlpool is because of the ETFs it's exposed to. So I do think that ETFs have been having quite a big impact on markets, which creates opportunities as investors for us. In terms of timing when that changes, it's really hard to know. And for me, I think what changes it is if you do actually see a recession or a weakening economy, then the earnings trajectory of these businesses will actually decrease quite significantly. People don't realize how cyclical industrial companies are, how cyclical technology companies are, that their growth profiles don't just go in a straight line. When the economy does weaken, those businesses are actually quite susceptible. And so I think that would be a trigger for a rotation back into some of these value sectors, which we're actually seeing multiples trading at significantly low levels compared to their historical averages.
Thanks, Gary. We've got two more questions here. All caveats accepted. What forward growth estimates should I use on a superannuation earnings model if I'm planning to retire in 5 to 10 years? I'm currently using 5%. Is that too conservative based on your experience?
So I assume you're talking mainly about investing in equities, or if you're talking about just your equity component of that, then I think that probably 5%, 5 to maybe 10% is probably the right number. But as we know, there's going to be volatility over the years. So, I'd probably expect from today's market, your 5% is probably not a bad starting point. But it always depends on the date that you're entering. In terms of a balanced fund, that 5% probably is very sensible. And what I try and do with the portfolio is try and have some more defensive businesses in the portfolio that really don't go down as much in a weakening economy and pay healthy dividends. So, if you've got an equity portfolio of 3%, call it 3 or 4% dividend yield, and then you're thinking about capital appreciation of probably 3 to 5%, then you're getting 5 to 10% in terms of total return.
Thanks for that, Gary. We've just got one last question based on a previous comment. So you don't see the historically high international debt levels as a concern?
Yes, I mean that would be my other area of concern in markets today, and that's part of the reason why governments are reluctant to increase interest rates, and the Fed's got on hold, is that there is a lot of debt in the world, and so we've seen in Australia that basically capital constraint by the banks can create decreasing asset prices in housing, for instance, because of the level of debt that we have in certain countries, that is sort of depressing asset prices, but also demand. So it's an interesting scenario where it's hard to see how debt levels go higher than where they are today, but without increasing interest rates, it's not having an effect on economic growth. And so as long as people are employed and have jobs, then they can make their interest rate payments, but also make their principal payments, which should reduce the debt levels over time. If you actually look at the consumer household debt levels in countries like the US and China, they're actually quite low. So the US, the household debt levels have come down quite a bit since the GFC. It's very different to Australia, where household debt levels are very high. So, and if you look at China, even though people talk about the building levels of Chinese debt, that's really more in the government sector and more in the state government sector. But people don't look at the other side of the balance sheet, which is the asset side. And when you look at China, the government has a tremendous amount of assets that they can service the debt. Japan's a good example of a country which has a high level of government debt to GDP, but all that debt is actually held by their citizens, and the Japanese consumers are actually big savers. So the key question is who actually holds the debt, and the holders of that debt, will they continue to, be happy to get a low rate of interest rates for that investment? Because if one day they're not, then that's what's really going to cause a big problem in global markets.
Cool. Thanks, Gary. I think we'll wrap up there. Thanks very much for sharing your insights, and thanks everyone for joining us. We hope you found the session really valuable. As a reminder, for those of you who are after your CPD point, we'll just get you to complete the feedback survey after we end the webinar, and we'll be sending the slides and details within the next week. In case you're interested, you can view all of the managed funds and their performance on our platform. You can visit the Compare Funds and Models page, which you can find under the Personal tab and Research and Tools. We also have a podcast on our portfolio construction series, where we pick the brains of wealth management professionals to uncover interesting insights and opportunities. We're just about to record one with Gary now, so keep an eye out for that. Thanks, everyone.